In this video, I'm going to walk you through the 6 steps of the purchasing process. It all starts with a request for goods or services. Then the company purchases the goods or services. The goods or services are received. The company gets an invoice. The company pays the invoice, and the accounting records are updated accordingly. So let's walk through this in greater detail. And we'll start with step 1, the requisition for goods or services. So there's an authorized individual at the company that says, I need something. I need maybe raw materials. I need supplies. I need some type of service. Okay. That request is then approved, and then it's going to go to purchasing. Now, this purchase requisition, typically there is a form that you have to fill out. So the last university that I was a professor at, if I needed some kind of equipment, for example, if I needed a laptop or I needed a desktop or something to do my job, what I would do is I would have to fill out a form and say, look, this is specifically the computer or whatever it is that I need. I need 1 of them. I need 2 of them. Okay, I specify exactly what it is that I need. And then I sent that to the admin department, and then someone had to approve it. And then it went to purchasing. Okay, so there's a request for goods or services. Assuming that that request is approved, then it goes to purchasing. Okay, I didn't actually go and purchase the laptop. Okay, somebody else at my organization went and purchased the laptop. Now, when they go and purchase that laptop, they're typically buying from what is called an approved vendor list. By the way, you'll hear this word vendor a lot when we talk about the purchasing process. Vendor just refers to one of the company's suppliers. So there might be a list. They might say, okay, there's Dell. Okay, that's an approved vendor. We can buy stuff from Dell. If they're not on the approved vendor list, typically the company can't buy from them. There are things you can do to get someone on the approved vendor list and stuff. This is an internal control that we'll talk about later. Okay, but let's just say I make this request for this Dell laptop. Dell is on the approved list of vendors. Okay, how might they have got on the approved list of vendors? Well, my organization, my university that I was teaching at had worked out a deal for certain pricing. That, okay, if we buy enough computers from Dell or whatever, they'll give us preferential pricing. Okay, so basically, I make this request for this computer. There's a form, I fill it out, it gets approved, and then there are other people at the organization that go and make the purchase. Now, there are different types of purchases. Like one thing is just for someone to go and just submit an order from Dell. But another thing is if a company is buying a lot of a certain product, they could go and say, well, actually, we're going to solicit bids from multiple vendors. So we're going to go and we're going to say, you know what we need? We're starting a university and we're going to need 10,000 desktop computers, and we're going to solicit bids. Which company would give us the best price on these 10,000 computers? Another way of making a purchase is where it's just automated. Okay, sometimes when a company has where it's set where their inventory level gets below, it hits a certain threshold, like, oh, we sold through enough inventory. They have it automated where it just automatically reorders. Okay, so there's a purchase happening there. No one's actually even doing anything. It's just happening automatically. You could also have a blanket purchase with multiple delivery dates. So for example, you could say, all right, we want to buy 120,000 units from this vendor, but we want it spread over 12 months. So every month, we're going to receive delivery of 10,000 units. So we're buying 120,000 units, but we don't want them all to arrive at once. Okay, so every month for 12 months, we're going to receive 10,000 units. So the order was for 120,000 units, but you're taking delivery on a periodic basis. Okay, so there's, again, multiple ways to purchase goods and services. Now, you requested the goods and services, you purchase them. The next step is you receive the goods and services. Now, when those goods show up, okay, assuming that, so let's say we're talking about inventory that was purchased and the goods show up, there's going to be what's called this form called a bill of lading that you're going to get. So the delivery truck shows up, there's this bill of lading, and it says, okay, here's what is on this truck that you're receiving. You're receiving 100 units of whatever, okay? So the bill of lading should have the purchase order number. It should be matched to the purchase order. You want to make sure that, like, if you're on the receiving dock for this company and these goods show up from the vendor, you want to make sure, did we actually buy these? Okay, maybe by accident, the vendor just says, hey, look, here's 100 units of this, and you didn't even order that. Okay, now Also, the people in the receiving department for your company are going to inspect the goods. You want to make sure you're not receiving damaged goods or the wrong number of goods. So they're going to inspect the goods for quality. They're going to count the goods, and then they're going to prepare a receiving report and say, okay, look, we ordered 100 units of this product, and we received 100 units of this product. Now, this is the point. This is the point where the company has technically incurred a liability, right? They've received the goods, or if they were services that were provided, okay, there's typically a form that's filled out to say, hey, we received these services, and then the company has incurred a liability to that vendor. After you have received the goods or received the services, you're going to receive an invoice from that vendor, okay? So the accounts payable department is the department at the company that is typically responsible for processing the invoices. That's what accounts payable does. And so they're going to enter the invoices into the system. Ideally, and this is an internal control we'll talk about in a future video, that you want to match the invoices to the related receiving report and purchase order. Okay, this is called a three-way match. For everything to ensure that this was a valid purchase of this company, there should be a purchase order saying, hey, we actually bought these goods, we ordered these, we actually received them, and now we're being billed for them. Okay, that indicates that it's a valid purchase. Okay, now typically there's this thing called a voucher packet or voucher package, where there's this document called a voucher. Okay, so if you work with accounts payable at all or something, you hear about people, oh, we've got this voucher or we're paying this voucher. So this voucher, so you've got the receiving report, you've got the purchase order, you've got the invoice. So those are three documents. In this voucher is this fourth document, okay, and you could think of it as a cover sheet. So if you think of, we got this document, we got this document, we got this document, and then we put one document on top. Okay, and that is the voucher, the cover sheet. And that's like if anyone in the accounts payable or anyone at the organization is looking at all these different, instead of just getting a bundle of papers, there's this thing called a voucher on top. Okay, and the voucher says, okay, here's the name of the vendor, here's who we bought this from, here's the amount we owe, any discount terms, maybe we get a 2% discount if we pay in 30 days, the date when we need to have made the payment, approval signature, and so forth. So you've got, ideally, again, the invoice, the receiving report, the purchase order, all match, and then you have this voucher document on top, just kind of summarizing all the information and serving as the cover sheet. And then all these documents together, again, we'll call the voucher packet or voucher package. Okay, so you got the voucher summarizing everything that happened, and then you've got the supporting documentation, and then you put that all together. That's your voucher packet or voucher package. So you've received the invoice. The next step is to pay the invoice, okay, a disbursement. So you've been billed by this vendor. They provided goods, they provided services. You say, you know what, we've got a receiving report that shows that we actually received those goods or services. Purchase order shows that we made a purchase. So now we need to pay this invoice. You could pay by check. You can make an electronic transfer. Okay, now the voucher, so that top page of that package should be stamped paid to indicate that, look, this has already been taken care of. Okay, then again, that's another internal control. You don't want to end up paying the same invoice twice. And we'll talk about that in a future video. Finally, okay, so you've made the payment, you received the invoice, you paid the invoice, you want to make sure that you've updated the accounting records. Now, back when you receive the goods and services and they have been performed, remember I talked about the step with the receiving report, that's the point where you've technically incurred a liability. Okay, so you should have credited accounts payable and then debited some other account. So if you had received inventory, you would have debited inventory. If you'd received supplies, you would have debited supplies and so forth. Okay, now when you go and make the disbursement, okay, this step here, when you've made the disbursement, so to update the records for that disbursement, what you should do is debit accounts payable. Remember, accounts payable is a liability, so it increases with a credit. So you would decrease it because once you made the disbursement, you have paid that account payable, so it's no longer payable. So you would debit the accounts payable, and then you would credit the cash account. So now that you've updated the records, the purchasing process is complete.